All right, guys. So, first of all, welcome to you all, right? Today we are here to give a befitting tribute to Professor John C. Hull, right? And it's a tribute. Today we are not just remembering a professor, but we are honoring a man who transformed your global finance education. Professor John C. Hull did something very extraordinary. He democratized quantitative finance, the difficult concepts in finance. Any student who has passed your difficult financial exams like your CFA, your FRM, CQF has always referred to his books. And before his work, derivatives and risk modelings were confined to your mathematicians, your PhDs, and a small academic elite. After his work, they became accessible to everyone, students, your risk managers, traders, professionals across the world, including people like me. When I prepared for your FRM, CFA, and CQF, when I built my risk models, when I tried to understand volatility, credit risk, derivative pricing, I was not just reading a textbook, I was learning a way of thinking, right? And the best part was that his philosophy was simple, yet very profound. That's why we believe that it was simplification without loss of rigor. He showed us that the complexity does not need to be intimidating. It needs to be understood. And that is why today's tribute is called your democratization of finance. Okay. Anyone who is new to this area, please understand when I say democratization of quants or democratization of finance, it means he made advanced mathematics usable for your real world finance professionals. He did not dilute the math, but he clarified it. He did not remove the rigor, but he removed the confusion, right? For many of us in this room, Professor Hull was not someone we actually met in life, but he was someone who shaped how we think, right? So I want to give today a very respectful, very grounded, a very personal tribute to him by this lecture. Okay? All right, guys. Before we start, right? Before we go any further, let me briefly introduce who are we, who is standing here giving this tribute. We represent Riskhub, right? Riskhub is basically a platform dedicated to risk management and quantitative finance education. Between us, me and Prateek, we have spent decades in your global markets, your risk management, your banking, your quantitative modeling across your institution like your Goldman Sachs, JP Morgan, HSBC, EY, PwC. We hold certifications like your FRM, CQF, CFA. These are the credentials that many of our students aspire to achieve. And I want to add a very important thing here is that none of this journey, not the FRM, not the CQF, not the CFA, not the derivative modeling, not the risk framework we use in practice would have been the same without Professor Hull's work. In many ways, we are not just your instructors. We are second generation beneficiaries of his Professor John C. Hull's intellectual contribution. The knowledge which we teach today was structured for us by him, right? We also believe that when you study your FRM or derivatives, you are indirectly studying your Hull or Hull's book. His books has shaped the curriculum. His explanation has shaped how professionals understand risk. So when we teach today, we are carrying forward that framework. Please remember that this is not a tribute from your distant admirer. This is a tribute from practitioners whose careers were shaped by his clarity. Okay? So that's the main thing. Now, what is important to understand here is that before this democratization, right? Theory lived in your academic journals, practice lived in your trading floors, they barely spoke to each other, right? There was a gap between your mathematics, there was a gap between your mathematicians, your traders, your risk manager. Hull helped close that gap, right? This is where our tribute becomes more grounded because we want to clarify that Professor John C. Hull was someone, in fact, the first one who was able to move from theory, the dense academic mathematics, to the practice and ultimately establish a bridge between them. Right? To understand Professor Hull's contribution, we must first understand the landscape before him. On one side, we had theory, dense academic papers, heavy mathematics, often accessible only to your physicists and researchers. On the other side, we had practice, the open outcry system, traders shouting, hand signal, chaos on the floor. These two worlds existed simultaneously, but they never spoke the same language before John C. Hull actually came out with his books and explanation. The mathematicians built models, the traders made markets, and very few could translate or talk or become a bridge between the two. That translation, that bridge, that link between theory and practice was Professor Hull, right? To make it simple, imagine having a brilliant formula on paper, but nobody in the trading floor understands how to use it. Or imagine traders making a pricing decision without fully understanding the math behind risk. That was the gap. Hull, Professor John C. Hull, made the math usable and he made the practice understandable. He did not invent the derivatives, right? But he made them understandable to the whole world, right? So keep that in mind, and that's why we revere him so much. The next aspect which I want to highlight is that as the financial markets have evolved in years, right, derivatives are now no longer your exotic instruments. They are very essential tools for managing your interest rate risk, currency risk, credit risk. Volatility matters, LIBOR matters, USD and GBP curves matter. The mathematics exist, the markets exist, but there is a problem, right? Wall Street lacked a common language. Your academics or academicians spoke in your stochastic calculus. Traders spoke in your prices and spread. Risk managers spoke in sensitivities. And very few people could fluently speak all three, right? Your stochastic calculus also, your price and spreads also, and sensitivities also. The market required something very specific, a bridge between Wall Street application and your ivory tower theory. The bridge was Professor John C. Hull, right? Anyone who is new to this world, think of it this way, that one side had formulas like your integrals, your sigma notation. The other had your traders shouting bids and offers. Without translation, both sides were incomplete. Professor Hull created a common language. He did not simplify the mathematics, he structured it so that the markets could use it. Okay. So we understand his legacy. We are one of the beneficiaries of his work. There was definitely a disconnect between your academicians and your practitioners, and the market needed a bridge, right? So that's what we need to understand. Okay. What is more to understand here is that Options, Future, Other Derivatives was the first book he published. It was published in 1988, became both a top academic textbook, the Bible of your trading rooms. That dual impact has been extraordinary and has been very rare in the financial world, right? Very few books achieve what the Option, Future, and Other Derivatives book has achieved, right? So in 1988, when Professor Hull published this book went into reshape your global finance education. It was not just another academic text, it became something much larger. It became the common language of derivatives. It was very unique in its impact. It was simultaneously a best-selling university textbook and the Bible of your trading norms, right? Think about that for a moment. a single book which was trusted by students preparing for exams and by traders managing your real capital. That level of clarity, that level of intellectual trust is very, very rare. When personally I prepared for your FRM, CQF, and CFA, I tried to truly understand Black-Scholes, Greeks, interested model. This book was my foundation, not because it simplified the mathematics away, but because it structured it so beautifully that understanding became very easy. Right? So many books are either academic or practical. Professor John C. Hull's book was both. Professors taught from it, traders priced from it, risk manager validated models using it. And he did not just write a textbook, he standardized how the world learns derivatives, and generation of quants were trained on those pages of this book, right? So there is a tangible legacy, there is a global influence, there is a intellectual permanence, and there is a deep personal connection of any quant to this part of the book. Okay. Now, when you talk about democratizing the Black-Scholes model, please understand before Professor John C. Hull, Black-Scholes was seen as a mysterious formula, a black box kind of equation. After Professor John C. Hull work, it became the logical step-by-step framework. There were inputs, there were assumptions, there were no arbitrage, replication Greeks, and theory translated into your practical tools like your Derivagen software. Okay, so let us take one example, right? The Black-Scholes model. Before structured teaching for many students and practitioners, it felt like a black box, a formula to memorize, a mysterious equation with your sigma, ND1, ND2. It worked, but very few understood why. Professor Hull changed that. Okay, he did not present Black-Scholes as magic, he presented it as logic, step by step, no arbitrage reasoning, risk neutral valuation, replicating portfolios. Suddenly, the equation was no longer a black box, it was a structured framework. When I first understood delta hedging, right? When I saw why the model works rather than just how to plug your numbers into it, that clarity came from your Professor John C. Hull's book's explanation. Okay? Think of it as being given a machine without understanding how the gears move. Professor John C. Hull opened the machine, he showed every gear. He made us understand not just the formula, but the intuition behind it. And if you talk about your Derivagen, it did not stop at your explanation. Through tools like your Derivagen, he brought through to life. Students could change volatility, interest rates, maturity, and see instantly how your prices and Greeks respond. That is democratization, not just reading theory, but interacting with it. He also turned your complexity into clarity without ever sacrificing your mathematical integrity. He did not reduce the math, he elevated our understanding. And that's what was the best thing about him, right? So please understand that when you talk about Professor John C. Hull, his legacy, right, his methods, the whole idea is that if I had to summarize Professor Hull's contribution in one sentence, it would be this: simplification without loss of rigor. This is far more difficult than it sounds. Anyone can oversimplify, anyone can dilute mathematics, but to preserve full mathematics integrity while making it intuitively clear, that is rare intellectual craftsmanship. And you should look at his book, how he has explained futures, clean logic, clear payoff diagrams. Look at how he has explained a short hedge, one straight line, where suddenly risk exposure becomes visible. You look at swaps, what once felt complex because becomes a very simple exchange of cash flow. He had the ability to strip away noise and reveal your structure. When I teach today in Riskhub, right? When I draw your payoff diagrams on the board, when I explain why a hedge works rather than just that it works, I realize I'm following the same philosophy, right? So you can see Professor John C. Hull didn't give us the formula, he gave us the mental models. He made student like me comfortable with complexity. After reading him, derivatives didn't feel intimidating. they feel logical, and he didn't make your finance easier, he made it clearer. True rigor does not confuse, it kind of clarifies, right? So we loved his teaching style, we loved his analysis. He has influenced generations, which personally resonate with me as an educator, and his impact will continue for many more years, right? So that's what we need to know. Then we have the interest rate problem, right? Now, Black-Scholes assume your stock prices follows a random walk that works reasonably for equity, but interest rate behave differently. Rates exhibit mean diversion, term structure constraints, so the old framework was kind of insufficient for rates. Hull helped structure and explain the evolution clearly. So as markets matured, another challenge emerged, the interest rate problem. The Black-Scholes formula assumes that underlying prices follow a random walk. For equity, that approximation works reasonably well, but interest rates are kind of different, right? So rates do not wander freely, they tend to revert to a long range average. And more importantly, right, any realistic interest rate models must fit today's yield curve. Now, this may sound very technical to some of you, right? But it reflects something deeper. Professor John C. Hull did not stop at explaining the Black-Scholes. He carefully examined or explained its limitation. He helped generations understand why your interest rate models require mean diversion, why we have term structure, which matters, why your calibration matters. He loves or he taught us not just to use model, but to question their assumption, right? So we understood that stock prices can drift up and down unpredictably. We understood that interest rates behave differently. They tend to move towards an average. So using the same model for both would be wrong. We understood that the Hull made this distinction clear and showed how to think properly about your interest rate modeling. And if you think about it, right, the true understanding is knowing where a model works and where it doesn't, right? He trained us not to worship formulas, but to understand their foundation. And this is very, very important to understand because it shows your intellectual maturity, critical thinking, evolution beyond your Black-Scholes, his impact on your interest in modeling and risk management, right? And this is very vital concept which connects very well to any quant's background, right? Because if you're in fixed income, your rates, your XV, global market, right? Modern risk management, post-crisis, broader legacy in FRM risk, everywhere it works, right? So keep that in mind. Then we talk about the Hull-White solution 1990. Basically, the problem was that Vasicek had mean diversion, but it could not perfectly fit today's yield curve. There was an innovation required, extended Vasicek. Introducing your time-dependent parameters allowed exact fit to the current term structure. Impact was that there was a perfect calibration, real-world implementation used in pricing your swaps, swaption, risk system. And this is your serious intellectual work. Now, in 1990, Professor Hull, along with Alan White, introduced what became one of the most influential interest rate model in the modern finance, the Hull-White model. Hull-White model has two factors, Hull-White model one factor, Hull-White model two factors. The Vasicek model, which was before this, captured your mean diversion, but it could not perfectly fit the current yield curve. So in practice, that matters because if your model cannot match today's term structure, it cannot price accurately. So the innovation was elegant. You introduce your time-dependent parameter, extended the framework, allow the model to fit the yield curve exactly, a perfect fit without abandoning your mathematical discipline. Many of us who have worked in fixed income, who have calibrated your interest rate models, who have valued your swaps or swaption, have relied directly or indirectly on this framework. This is all about your contribution, not your pedagogy, right? Please understand, interest rate models must watch today's yield curve. Hull-White allowed that while keeping the mean diversion impact, and it made theory usable in real market, right? So he did not just teach the evolution of interest rate models. He shaped the evolution. The bridge between theory and your markets was not accidental. He helped kind of engineer it. So there was a gap. He created a common language. He democratized the Black-Scholes. He elevated your understanding. He kind of advanced the interest rate modeling, and he left a practical legacy in the global market, right? That's what we need to understand. All right. When you talk about visualizing the model, right, the trinomial tree, right? So the basic idea here is that the trinomial tree is a numerical implementation which is used for your pricing derivatives, part dependent interest rate derivatives. Applications are your Bermuda swaptions, your caps and floors. There are different methods used here, which are like your numerical implementation of term structure model. And this shows your practicality, your computability, your engineering mindset. So what we need to understand is that a model is only as powerful as its implementation. The Hull-White framework was not just theoretical elegance, it was computationally usable through your tools like your trinomial tree, complex interest rate derivatives, your Bermudan swaptions, your caps, your floors became numerically tractable. And this is very important to understand because many models look beautiful on your paper, but market requires implementation. Hull White or Hull model ensured that his framework could be transformed into your numerical procedures, structured, stable, and practical. And when you build a tree model, when you discretize an interest rate procedure, when you roll backward to price your optionality, you are working within a structure which John C. Hull helps standardize, right? So think of a trinomial tree like a decision map. At each step, rates can move up, down, or stay the same by mapping all possibilities and working backward. We can price your complex products. Hull made sure these models were not just elegant, but usable in your real financial systems. And he did not just stop at your insight, he ensured execution. The true impact in finance is not just theory, but it is theory that runs in the systems, right? So that's what we need to understand, right? So John C. Hull covered the gap, the bridge, the book, the Black-Scholes clarity, interest rate modeling, evolution, Hull-White innovation, numerical implementation, global impact, right? That we need to understand, right? So it has a great legacy, influence on generation. We are grateful for that. And the idea basically democratize or democratization continued, right? Then uh, what we need to understand is that as we move from your innovation to responsibility, we are moving from pricing to your systemic awareness, from elegance to relevance. We need to understand that pre 2008, right? Assumptions, when you talk about banks, were effectively your risk free. Your in reality, your counterparty risk is very much systemic. So, John C. Hull pivoted your focus from pure pricing to risk management, added focus on your credit risk and your CVA. And this is this is what shows that there was great intellectual humility, adaptability, relevance across crisis, and it was alignment with your FRM and your risk discipline, right? So what we need to understand is that before the crisis, there was an implicit assumption in many models that large banks were effectively risk-free. That assumption collapsed in 2008. The crisis taught us something. Fundamental counterparty risk is systemic. Price models were not just enough, right? Risk management had to evolve step by step. Professor Hull evolved with it. His focus expanded from pricing derivatives to understanding of credit risk, credit value adjustment, CVA, and systemic exposure. He did not defend old assumption. He updated the framework. Many of us who prepared the FRM, who work on XVA, CVA, counterparty risk, have benefited from that evolution. He trained a generation not just on price risk, but to kind of respect it, right? So what we need to understand is that before 2008, many models assumed banks would not fail. After Lehman Brothers collapse, that belief kind of disappeared. Hull, John C. Hull adopted his teaching to include your counterparty risk and credit exposure. He ensured the discipline matured with the market. And great thinkers like him do not cling to your old models. They refine them when reality kind of changes. His legacy is not just about clarity in the calm markets, but relevance in the crisis, right? So, as a practitioner, what I want to say is that Professor John C. Hull democratized quant finance. He built bridges between theory and markets. He turned formula into your frameworks. He turned complexity into your clarity. And perhaps most importantly, what we need to do is that he trained generation of professionals to think rigorously, right? So many of us never met him personally, but every time we draw or we do a payout diagram, calibrate an interest rate model, computed a rate value adjustment, or teach a student about derivatives, right? His influence is present. This is the true legacy which he holds. And this is the simplification without loss of vigor, right? So this is what we have, right? Then next part is that we want to talk about uh, the full evolution which we saw, right? From your pure risk-free pricing to reality adjusted valuation. This is where we saw the fact of or the impact of John C. Hull's framework. So before 2008, as I told you, right, risk-free valuation was assumed, LIBOR treated as proxy for risk-free rate. After 2008, OIS discounting replace your LIBOR, right? Uh, OIS is overnight index swap. Counterparty risk explicitly priced risky valuation is equal to risk-free valuation plus your CVA. And that was not just a technical change, right? It's a paradigm shift we have seen. And the crisis of 2008 did not just change the markets, it redefined your valuation itself, right? Before 2008, many derivatives were priced under the assumption of a single risk-free curve. LIBOR was treated as the proxy for risk-free funding. That assumption no longer held. The framework evolved. OIS discounting option, uh, overnight index swap discounting replaced your LIBOR. Counterparty risk was explicitly embedded into valuation. Risk-free valuation or risky valuation becomes risk-free valuation minus a CBA. This may look like a simple adjustment, but conceptually it is profound. It means we no longer pretend that risk doesn't exist. We price it, we manage it, we respect it. For many of us working in CVA, XVA, counterparty risk, this framework is foundational, and the intellectual groundwork, clarity, the structure, the discipline came from thinkers like Professor Hull, right? Then look at the simplified explanation for audience. The idea here is that earlier we priced derivative as if banks could not fall, all right, or banks could not fail. Now we adjust prices to reflect the possibility of default. That adjustment is called CVA, which is your credit value adjustment. And John C. Hull help integrate this thinking into your mainstream risk education, right? So that's a very important change, right, which has happened with time, right? So uh, overall, what we need to understand here is that Professor John C. Hull did not merely write about derivatives, he bridged theory and practice. He prevented rigor or he preserved rigor while promoting your clarity. He evolved when your markets evolved. When you move from Black-Scholes to Hull-White to credit risk and CVA, his intellectual footprints run through your modern quantitative finance. Many of us never met him, but every time we kind of teach a payoff diagram, every time we calibrate a term structure model, every time we compute a CV adjustment, we are working within structure he helped build, right? This is democratization. This is the legacy we are talking about. And that's what I'm taking a presentation here, right? That's the idea. And as we go ahead, there are many other concepts, like if you think about your VAR, right, which is the historical concept, and then we talk about the expected shortfall, which is a more rigorous successor. The focus shift on your tail race momentum or movement towards capturing extreme event, evolution of risk discipline, post-crisis. This reflects your intellectual maturity of the industry, shift from your comfort metrics, current risk measure, alignment with the Basel III, FRTB evolution. And what is important to understand here is that the evolution did not stop at your pricing and your CVA. It extended into how we measure your risk itself for years. Value at risk, VAR, was the industry standard. It gave us a threshold. This is the loss we should not exceed at a certain confidence level, but war had limitations, right? It did not fully capture what happens beyond that threshold. It did not fully respect the tail race. This discipline evolved towards your expected shortfall, which is also called your conditional war, measuring not just the boundary, but the average loss in the tail. This shift reflects something deeper, right? It reflects your intellectual honesty, it reflects your maturity, it reflects the willingness to confront extreme events directly. And in your FRM preparation and regulatory discussions in real world risk management rules, this evolution is kind of critical, right? So thinkers like Professor Hull help frame this transition clearly for generation of practitioners. War was telling us you probably won't lose more than this. Expected shortfall, which is a worthy successor of war, that if you do exceed it, how bad it can get. The shift is about respecting your tail risk, the kind of risk that caused the 2008 crisis. The true rigor is not about predicting your comfort, it is about your measuring your discomfort honestly, right? So he trained us to look beyond the boundary into the tail, right? So it's very important that by understanding such things, right, we were able to get a good idea about derivative pricing, interest rate modeling, numerical implementation, counterparty risk, your CVA, XVA, risk measurement evolution, right? This is your comprehensive impact we are talking about, right? So Professor Hull did not merely explain your models, he shaped how the financial world thinks about risk, and we as educators and practitioners carry forward that architecture, right? So that's the whole idea. Then now we are talking about the latest phase, which is 2016 to 2026, pivot towards AI and machine learning. Professor John C. Hill authored Machine Learning in Business, recognized that closed form solutions are no longer dominant, right? The latest book, shift from purely analytical analytical modeling to data-driven modeling, right? Embrace of data science was one thing, right? This shows your intellectual honesty, intellectual flexibility, your curiosity, your future orientation, humility before your technological change. So, what makes your Professor Hull's legacy even more remarkable is that he did not remain confined to your classical quant finance in the later years of his career. In the fag end of his life, he pivoted towards artificial intelligence and machine learning, which is making a big mark now, right? And after decades of shaping the stochastic calculus in finance, he recognized something very important. The era of purely closed form solutions or formulas was also evolving. Data was becoming more central, machine learning was becoming more practical, and finance was changing once again. So instead of resisting this shift, he kind of embraced this, and that is the hallmark of a great visionary leader. Through his work on machine learning in business, he signaled that the future quant must understand both mathematics and data science. And this evolution reflects something profound. True rigor is not rigid, it adapts. He democratized quant finance in the 1980s. Then he again democratized quant finance in 1990s. And in later years, in the fag end of his life, he helped prepare the next generation for the AI era, right? So earlier finance relied heavily on your formulas like your Black-Scholes. Now machine learning models are also used for prediction and risk analysis. Hull understood the shift and guided students towards this new reality that shows intellectual courage. And this is the most important thing, right? So what we learned from Professor John C. Hill, that Professor John C. Hill's journey mirrors the evolution of modern finance, from Black-Scholes to Hull White to CVA and risk management to expected shortfall, and finally to your artificial intelligence. He remained intellectually very curious, he remained intellectually very rigorous and intellectually very forward-looking. Democratize your quant finance. He taught us to respect your assumption, he taught us to question the model, he taught us to adapt when reality changes. And many of us, right, who have built their career and progress in the career in the last 10, 15 years, have built the career on the frameworks he have clarified. And as educators and practitioners, we now carry the responsibility forward that we have to have simplification without loss of rigor. Thank you, Professor Hull, for all this understanding. And that covers our gap between theory and practice. This particular book, which I'm talking about, Standardized Derivatives Education, Black-Scholes Demystified, your trusted modeling refined, hull void implementation, CVA, counterparty risk, evolution of risk measure, pivot to AI, and legacy and your forward responsibility, right? That we understand. Okay. Then we also talk about neural networks versus Black-Scholes, traditional models, which were Black-Scholes, tree models, your partial differential equation solvers were structural, your theoretically grounded, computationally expensive, struggle with the complex volatility surface. Neural networks, which have come recently, trained to approximate your pricing functions, faster executions when trained, capture your non-linearities, volatility smile and skews. This is not your AI versus math, it is the evolution of the tools. So as we move into the AI era, a natural question which has increasingly being asked is classical quantitative finance being replaced? We now see neural networks trained to replicate your pricing model. They execute faster. This capture your complex non-linear patterns such as your volatility smiles. Traditional models like your Black-Scholes or tree-based implementation can be computationally very intensive, but they struggle when the market becomes highly non-linear. But this is not the story of a replacement, it's the story of evolution. Neural networks do not emerge in a vacuum. They are trained on frameworks that think of like Professor Hull help structure. You cannot approximate what you do not first understand. The mathematical discipline he instilled become even more important in the age of AI because when models become data driven, rigor becomes the safeguard to understand them, right? So Black-Scholes gives us a clean formula. Neural networks can learn your complex patterns from data, but machine learning models still rely on your financial intuition built by your classical theory. And Professor John C. Hull, by his frameworks, are given that foundation, right? So what we need to understand is that AI may change the tools, but your rigor remains the standard. Or in the AI era, clarity is not just optional; it is quite essential, right? So what we are getting here is that the thoughts and the processes introduced by Professor John C. Hull has not been outdated. He understood the evolution. He prepares students for a transition, and his philosophy applies even today strongly in the AI-driven finance, right? So uh, classical finance gave us the structure, AI gave us the speed, but the rigor, which we understood through his mathematical framework, was the actual gift he gave us. Okay. Then we are almost at the end of this tribute. Which I want to add here is that modern quant sits at the intersection of your financial theory, your delta, your gamma, your stochastic calculus, with your computer science, Python, machine learning, coding, algorithm. There's a message to any student here that don't study your uh, theory in isolation, don't code without understanding economics, master both. This aligns perfectly with the Hull's evolution from formulas to frameworks to AI to integration. And if Professor Hull were speaking to students today, I believe this message would be very, very clear. The modern quant is no longer just a mathematician or just a programmer. The modern quant starts at the intersection of your financial theory and computer science. You must remember delta, gamma, and you also understand your Python. You must know your stochastic calculus, but you must also know how to implement your models efficiently. Do not just learn your economics, you learn to code. Do not just train your neural networks, understand the financial intuition behind them. That synthesis, that intersection is the future. You can uh, understand, right, very clearly that in the past, finance and programming were separate. Today, they must work together. The best professional understand both your markets and code, and that's the modern toolkit, right? So, this is the final understanding I want to build. Professor John C. Hull legacy is not confined to textbook. It lives in your training desk. It lives in your REST system. It lives in your FRM classroom. It lives in your AI labs. He democratized finance. He made complexity accessible. He presented your rigor. He embraced your evolution from Black-Scholes to Hull to CVA to expected shortfall to machine learning. His intellectual journey mirrored the journey of modern finance itself. Many of us who have built our careers on this clarity, and now it is our responsibility to carry that same philosophy ahead, to have, again, a very simplified or simplification without loss of rigor. Thank you, Professor Hill, for this journey, right? So that's what we try to understand. And last but not the least, Professor John C. Hull from 1946 to 2026 was a great teacher, a great thinker, a bridge between worlds. His legacy is very, very clear. And his books, such as The Bible of Derivatives, The Hull-White Model, above all, the democratization of knowledge. For decades, his books sat on your trading desk, in university libraries, on the study tables of FRM candidates like me. It was more than a textbook, it was a gateway. Many of us never met him, but we met his clarity, we met his logic, we met his discipline. And though that we entered a world that once felt inaccessible, just he didn't just teach us finance, he gave us the key to the kingdom. So thank you very much, Professor Hull, for this knowledge. I'm not trying to make it dramatic or exaggerated. I truly believe that he has left us with his models, his thoughts, his relevance, or his thought process frameworks, which help me to succeed, right? So that's what we did. And that's what I want to say to all of you, that as a practitioner in the industry, the work done by Professor John C. Hull and the evolution which he has shared with his frameworks has done a great justice to my career, and I've used it a lot while teaching students as well, right? So this is what we have learned, and that's what I want to cover for all of you. I hope you know I was able to provide you enough knowledge about these models and the relevance, right, of his work in the world of finance, especially how he led this work to democratization of finance. He didn't just teach us finance; he gave us the key to the kingdom. And there's a definite legacy which every student must understand and follow. And again, right, simplification without your loss of rigor, right? So without loss of rigor, things were simplified, and we learned that, and this really helped us in career, and we have been carrying forward that legacy now, and we are teaching further students in Riskhub in the same way. Okay, that's it from my side, guys. That's it, what I wanted to convey today. I hope you understood, right? I tried to cover a lot of things here. The objective was just to make you realize that his work, right, in your 80 years of his journey, has evolved at so many places, so many functions, and how it has impacted each one of us, right? That's it, guys. That's it from my side. Thank you very much. Thank you, Professor John C. Hull, for all his work, and we are really indebted to him for his great contribution to the world of quant finance. All right. Thank you, guys.